Hey everyone, and welcome to today's Explainer. I am absolutely thrilled to dive into this one with you because, well, we're looking at a massive, rapid shift happening right now in the financial world. We are literally moving away from that old obedient banking software, the kind that just does exactly what it's told, and we're entering this wild new era of autonomous digital bankers.
So it really begs the question, right? What actually happens when software starts making the financial decisions? For decades, AI in banking was just about predicting trends, or say recommending an action for a human to take. But that is changing fast. The focus now is all about how AI agents handle banking by actually planning and executing complex tasks totally on their own.
Okay, let's take a quick look at our agenda. First, we'll cover the new digital banker, then how AI agents work, followed by rewiring the bank, the explainability problem, governing the algorithm, and finally, we'll wrap up with the future of autonomy. Let's get right into it. Starting off with Section 1, the new digital banker, and the rise of agentic AI in banking. Look, banks today are under immense pressure. You and I expect instant services 24/7 with absolutely zero friction. And honestly, traditional automation just isn't cutting it anymore when it comes to meeting that demand while still protecting margins.
Think of traditional AI as a super skilled but ultimately reactive assistant. It handles specific tasks when you trigger it, like a chatbot answering a basic question, but it still requires human oversight. Agentic AI? Well, that is a total game changer. These systems are completely autonomous and proactive. They aren't just executing a single task. They're orchestrating entire independent workflows, and they even learn from their outcomes over time.
Moving on to Section 2, how AI agents work, let's take a peek inside the AI brain. We need to look under the hood to see the actual mechanics of an AI agent handling these complex banking processes.
Let's walk through a real-world example, approving a 500,000 rupees personal loan. First up is the brain. This is the reasoning engine that frames the whole goal of evaluating the loan safely. Second is the toolkit. The agent securely grabs what it needs, accessing multiple systems like KYC for identity and hitting up credit bureaus for your history. Third is the thought process. The AI essentially uses a think, act, observe loop, applying its reasoning and carrying data from one step to the next. And finally, the outcome. In mere moments, the agent independently delivers a fully structured, approved loan offer directly to the customer. No humans needed.
Now, in really complex areas like anti-money laundering, one single agent just isn't enough. Instead, you get a multi-agent system. It's wild. Agent A reviews the system alerts. Meanwhile, Agent B is diving into thousands of historical transactions, a job that would honestly take a human a whole week and way too much coffee. Then, Agent C synthesizes all of it, documents the findings, and recommends the next steps. They communicate with each other like a team of digital detectives, catching things a human team might easily miss just because of the sheer volume of data.
And guys, they are incredibly effective at this. To put that into perspective, take JP Chase's law system, which stands for Legal Agentic Workflows. By using these specialized agents, their system processes ridiculously complex legal documents for custody and fund services with a stunning 92.9% accuracy rate across all sorts of queries. That is a massive success rate.
That kind of performance is exactly why banks are rushing to implement this stuff. Which brings us to Section 3, rewiring the bank, and the integration strategies they're using. Because, these institutions have massive, clunky legacy systems. So how do they actually install autonomous AI into that?
Well, they are tackling this in three distinct ways. First is a smart overlay, which is basically just wrapping a smart conversational AI agent right on top of their existing processes. Then there's Agentic by design. This is where they build brand new, specialized microservices entirely from scratch, so the agents aren't bogged down by decades-old code. And finally, process redesign. This is the whole shebang, a total workflow transformation to absolutely maximize the efficiencies that agentic AI brings to the table.
But across all of these strategies, there is one absolutely crucial concept you need to know: bounded autonomy. This basically means the software gets permission to make decisions, but only inside very tight, well-defined limits. For example, in a corporate treasury system, an AI agent might be allowed to rebalance millions in liquidity all day long, but it can only do so as long as it stays within strict risk thresholds set by a human. The second a threshold is breached, boom, the human steps right back in.
And that need for human oversight leads perfectly into Section 4, the explainability problem. We have to ask, why did the AI decide what it decided?
Because when you've got a machine thinking for itself, you're inevitably going to run into the conflict of how to explain its actions to both regulators and everyday customers.
In the U.S., the Consumer Financial Protection Bureau, or CFPB, has made their stance super clear on this. If a creditor uses a complex black box algorithm and denies a customer a loan, they are legally obligated to provide specific reasons for that denial. Just because the AI is technologically complex doesn't mean a bank gets a free pass to ignore its legal obligation to explain its decisions.
The rules are incredibly strict here. Let's say an AI agent lowers your credit limit based on some alternative data. The bank can't just brush it off with a vague checklist item. They literally cannot just say it was due to your purchasing history or disfavored business patronage. And if the algorithm discriminated based on your profession, they can't hide behind a broad excuse like insufficient projected income. Obfuscating the algorithm's logic from the consumer? Yeah, that is a massive no-go.
So how do they fix this? The crucial piece is implementing explainable AI, or XAI. XAI bridges the gap between these incredibly complex algorithms and the actual transparency required by law. It allows financial institutions to translate the AI's complex internal logic into clear, understandable reasons. And for sure, this is absolutely vital for building and maintaining customer trust.
Transparency is really just one part of the puzzle, though. The broader challenge sits at the very top of the institution, which brings us to Section 5, governing the algorithm and boardroom accountability.
I really want you to consider this striking quote from the Global Association of Risk Professionals. They state, AI is no longer an innovation story. It is a governance story. This is a major tonal pivot for the industry. We are no longer just marveling at cool tech capabilities. We are talking about serious boardroom accountability. Algorithms are now functioning as regulated decision makers. The problem is, there's a massive blind spot in the boardroom. Traditional boards are experts in things like capital adequacy and liquidity stress testing, right? But they often lack the tools to even understand AI bias. Plus, AI systems aren't static. They actually degrade over time. Customer behaviors shift and fraud tactics evolve rapidly. So these autonomous models require constant drift detection to make sure they don't veer off course. Just think about it. A poorly governed agentic fraud engine could mistakenly freeze thousands of legitimate accounts, causing massive customer harm.
Because of all these risks, we are seeing the rise of an entirely new class of executive, the algorithmic risk officer. This is a leader who has to be just as fluent in machine learning as they are in traditional banking regulations. Institutions that fail to evolve their risk leadership are facing a very real danger. They're going to find themselves governed by algorithms they do not fully understand.
So, where is all this leading us? Let's move to our final section, Section 6, the future of autonomy and what the agent-run bank actually looks like. What does this mean for the people working there and for you and me as customers? Let's pull all of this together. The most realistic autonomous bank won't actually be empty of humans. Instead, the role of humans is just shifting drastically. In the past, humans gathered info and executed the final decision. In the future, humans just move up the control stack. Their job will be to define the overall objectives, establish those hard limits we talked about earlier, and manage what we call exception overload. That means investigating all the complicated edge case scenarios that the AI just can't confidently handle on its own.
Which leaves us with this fascinating, lingering paradox to conclude our explainer today. If delegating execution to an AI agent actually requires way more explicit rules, harder limits, and much more rigorous auditing than a traditional human-run bank ever did, well, who is really in control? The defining question for the future of finance isn't actually how smart the AI gets, it's how carefully humans decide what it's allowed to do. Thank you so much for joining me today, and I really hope this deeper look into the autonomous bank leaves you with plenty to think about.